When you first get into dividend investing, there's this weird moment where you put in what seems like a bunch of money, and what you get back is basically pocket change. And you sit there wondering, is this actually doing anything? Or am I just wasting my time? And if you're watching this because you're debating whether you should get into dividends, this video is pretty much for you. Welcome back to the Daily Dough, where today we're going to discuss whether dividends are right for you. Now, if you're like most people, you've probably seen those videos where someone opens their app, shows off their dividends they got this month. Things like, here's my $1,200 I received. Here's how I got paid $600 this week. And instantly you're thinking, okay, why am I not doing that? It's inspiring. It makes you want to dive in immediately. But here's the thing, we always focus on the video where it looks like they've made it. Sometimes what we don't focus on is the other videos, the years it took to build that kind of portfolio, the deposits, the reinvestments, the boring consistency behind the scenes, how before they had big payouts came the really tiny ones, a few cents here, a few dollars there. So today let's look at this the right way, first with the basics. In very simple terms, let's say you have two companies and they both make a profit. Company one decides to pay you a piece of those profits. That's a dividend. You keep your shares and you get cash. Company 2 keeps the profits themselves. They reinvest it with things like new products, expansion, buybacks, anything that can push the stock price up over time. So dividends pay you now, growth pays you later when you decide to sell. And speaking about selling, let's talk about taxes, because this is where dividends and growth stocks really start to feel different. You have capital gains, which are profit you make when you sell a stock. So if you bought something at $100 and sold it at $150, that $50 is what gets taxed. And this is the big difference. With growth stocks, nothing is taxed until you actually sell. So you control when the tax event happens. So you can hold a growth stock for 5 years, 10 years, whatever, and you won't owe anything until you cash out. Dividends don't work like that. Because the company paid you cash for owning their stock, that payout counts as income. And the IRS wants you to report it for the year you received it. And yes, you are taxed on it even if you reinvest it, which sometimes can surprise those who are just getting into investing. Even if you never actually touch the money, it was still paid to you and it still counts as income. But not all dividends are taxed the same. You have some dividends that get taxed at a lower rate. Those are called qualified dividends. Others get taxed at your normal income rate. Those are non-qualified dividends. And if you're wondering how to tell which type of stock pays, it's honestly as simple as Googling it. Just search the stock name plus qualified dividend and you'll see right away. Most US companies and a lot of ETFs pay qualified dividends. However, you have REITs and many high yield funds that usually don't. So it's not something you have to memorize. You can find these answers pretty easily. And here's the good news. You can avoid these taxes by using certain accounts. You have Roth IRAs, traditional IRAs, 401ks. Inside those accounts, dividends can grow tax-free or tax-deferred. And growth stocks won't trigger taxes when you eventually sell inside the account. So a big part of choosing between dividends and growth comes down to control. Control over when you're taxed, and also which account you put these investments in. Something else you need to consider when deciding is volatility. How do you react when the market drops? Because the market moves up and down, and sometimes it moves a lot. However, dividend-paying companies generally move less. Why is that? Well, one reason is dividend companies are usually stable, established businesses. Think businesses like Coca-Cola or Johnson & Johnson. They make steady money, they've been around for a long time, they're not trying to reinvent themselves every quarter. Another reason is that people hold dividend stocks for the income. So even when the market gets shaky, income-focused investors don't dump these stocks as quickly. They still want a paycheck. So that steady demand helps keep the price from falling as hard. Whereas on the other hand, growth companies are the exact opposite. Their stock prices are based on what they might do in the future. So when the economy changes or interest rates move or earnings aren't perfect, growth stocks react fast. Dividend companies are valued more on what they're doing right now, and growth companies are valued on what they could be doing years from now. And anything built around future expectations is naturally going to move more. That's why dividend stocks feel a little calmer. And for a lot of people, that calmness is what helps them stay invested long term, which time and consistency in the market is probably the most important thing when it comes to investing. Because it doesn't matter if you have the perfect strategy or the perfect stock. If you panic sell all the time, you're never going to reach your goal. And here's something interesting to consider. Even though dividend investing feels different from growth investing, over long periods of time, these styles can help you reach the same goal. Both approaches can build wealth over time, they just pay out on different timelines. So instead of only asking which one makes more money, another question you should ask yourself is, which style keeps me invested long enough for compounding to actually work? Because when it comes to doing anything, learning a language, developing a skill, working out, consistency is always the best method. So how do you know if dividends make sense for you? Well, if you like seeing regular progress and small payouts keep you motivated, dividends probably fit your style. If you're okay waiting for a bigger long-term payoff and the volatility doesn't bother you, growth might be a better fit. If you're like me, you'll probably end up doing both. Dividend for consistency, growth for acceleration. So if I were to ask myself, am I wasting time with dividends? I would say, no, not at all. I like the little paychecks, they keep me investing, they keep me engaged, but I also invest in growth stocks because I understand how powerful they are long term. For me, using both makes investing sustainable, not stressful. But what about you? Would dividends help you stay consistent, or do you prefer the long-term payoff of growth? Let me know in the comments. I want to hear your perspective. And if you found this helpful, hit the like button, subscribe for more, and I'll see you in the next one.